Welcome to the Alex Merced cast, where Alex Merced of alexmerced.com brings you principled, thoughtful, libertarian commentary on issues that matter.
Hey everybody, this is Alex Merced from alexmerced.com, and you're listening to the Alex Merced cast. And this week's topic is taxes for a couple different reasons. One reason is because our new Congresswoman, Alexandria Ocasio-Cortez, who's actually our good friend Larry Sharp's Congresswoman, is basically been talking about high taxes. Basically getting everyone talking about whether high taxes are a viable thing or something we should be doing. So what I want to talk a little bit about, and then in response to that, Paul Krugman published an article trying to back her up on this, pointing out a couple different studies, which our good friends Robert Murphy and Tom Woods over there at the Contra Krugman podcast spent some time addressing. So they basically focused on the particular arguments that Krugman was making. And basically what Krugman was saying is that there was these two studies, one by Dr. Romer, I forget her name, but she was the head economist for the Council of Economic Advisors, Christina Romer, during the Obama years. And she wrote a study basically stating that the optimal tax rate should be 80%. And then there was another study that kind of made the same argument. And they were looking at it from the perspective of at what rate do you optimize government revenue relative to the disincentive to work. So in the sense that this basically taking that whole sort of Laffer curve concept where basically what tax rate do you achieve the most government income? The problem is that the conversation over tax rates shouldn't just be based on whether government gets more or less money. So I always hate it when people hinge whether taxes should be raised or lowered based on whether government revenue increases or decreases. It does matter to the extent that government needs to run a deficit, because deficits are bad. So to the extent that it does lower revenue, you should lower expenditures, which then leads to conversations about what things are more necessary or less necessary than others for government to do. But there's also the effect that taxes have on human behavior, and that's what I want to focus on today. Okay, the effect that taxes have on decision making. Because whether our economy grows or shrinks, whether government gets more or less revenue, isn't necessarily exactly what makes your life better or worse. It's the interplay of the individual decisions that people make and how that affects your life. So if there's more taxes, this kind of affects you in different ways and affects the economy overall in different ways. So one way, we'll first talk about investment. So if you're an investor, there are different types of investors. Those investors who seek safety and want to make a little return but keep their money overall safe, which is actually a lot more people than people realize. And then there's your investors who are looking to achieve sort of a higher return to grow their wealth. And the problem is that when you have a return on your investment, you have to pay taxes. So let's say you're in the 35% tax bracket and you have a 10% return on an investment. So the government's going to take away 35% of your 10% return, which means you're left with 7.5% of your return. Let's say inflation's running at 2%. So now that 7.5% that you got to keep has lost 2% of its purchasing power over the last year. So in that case, you're only 5.5% better off, which still doesn't sound too bad, and it isn't. But most people don't get a 10% return for the year. Okay, we're talking about sort of more like 5 or less. So when you're talking about that tax hit and that inflation hit, that eats up a lot of your return. And in that case, how do people respond? Do people just say, okay, well, I guess I'm making less money, nothing I can do? No, they're going to try to find new ways to make up for it. You're going to try to compensate for the effect of taxes and inflation. Okay, if you're an investor who's seeking return, okay, because there's a certain return you want to hit. So then what happens is that more taxes, more inflation, the way you achieve a higher return is you take a higher level of risk. So this pushes investors into taking higher levels of risk. So if you push taxes so high that all investors are being pushed into riskier and riskier investments, that creates a very unstable, investment environment. Now, in response, the government will then try to micromanage what people invest in by creating all sorts of tax incentives for investing in X, Y, and Z. But then what happens is that generally new ideas that haven't been thought of yet, okay? So there's not going to be any kind of tax preference for them, no tax reward for them. Oftentimes they're going to have a struggle seeking capital because either they're not going to return, some business models aren't going to return high enough and to make up for the taxes and inflation, and they don't have any tax benefits because they don't have necessarily the lobby to get the tax carve-outs out of the tax code to make them viable business models in that environment for people, or to achieve a sufficient return. So you end up sort of taxing out certain possible business models and pushing investors to take more risk. And then just creating a big incentive for a very complex tax code with all sorts of cronyism. Now, so that's on the investment side, and that has very large effects. But then there's also the effects on your daily life, where basically people, if they pay more taxes, they're not going to spend less money. They're going to probably save less money. And it's savings that is the capital base. I mean, literally all investment is savings. Whether you buy a stock, you buy a bond, you invest in a bank account or whatever, what you're doing is you're saying, this money I'm not going to use right now. I'm not going to go buy a burger or t-shirt right now. I'm saving it. I'm investing it. But if I tax you more, that's generally the money that gets first, because you're still going to pay for your house. You're still going to go pay for food and pay for the things you need. So it ends up hitting savings, which is the money that's used to sort of invest and create enterprises. Even if it goes into credit derivatives and CMOs and CDOs, that's all those are ways of helping parse risk of actual investments in actual enterprises and projects within the economy. So you end up starving all those projects. Okay, so you have less savings, which means less capital. Investors are taking more risk because they have to make up for what they're losing of their return. And then finally, what happens if you're a business and you're paying more taxes? You may have to raise prices, okay, which means, people are going to see the cost of living go higher. And the thing is that the problem is they're paying more taxes as well, so they're seeing their purchasing power go down because they're keeping less of their paycheck, but everything they spend on costs more money, which then creates a huge problem, because then you have people who are sort of marginally getting by, and that can end up putting them across the line where they're not getting by. So now they're seeking sort of assistance, and nowadays people are just used to seeking assistance from government. So then what happens now? People want more assistance from government because you've just pushed them below that line, and that means there's going to be more demand for these funding of these programs, which means more taxes, which means then that same dynamic happens again, and then there's more people who are sort of now seeking assistance, and it just becomes a cycle that cannibalizes itself. So there are some bad effects to raising taxes, especially raising taxes a lot. Now, when we've had high taxes in the past, or high tax rates in the past, they weren't really that high. You had a very generous tax code. But the problem is that instead of investing in what you thought was a good idea, you'd have to invest in sort of enterprises that were favored by the tax code, so that way you can actually keep your return. You'd have to the government used the tax code as a way to micromanage your life by saying, well, you get to keep your money if you spend it the way we want you to spend it. So traditionally, the tax rate discussion in the U.S. has really not necessarily been more of people paying a larger or smaller portion of their income, because effective tax rates haven't changed that much over time with a higher tax code or a lower tax code, but more a question of, do you get to keep the money that you earn? So, and do you get to spend it the way that you want? So that's kind of what I wanted to summarize today. Some food for thought. My name is Alex Merced. You're listening to the Alex Merced cast, which is on iTunes, Google Play, and Stitcher. And then what I am doing is syndicating all my podcasts on Anchor.fm, where now you can listen to it on places like Pocket Casts, Spotify, if that's where you listen to your podcast. So if you have friends who aren't listening to the show yet, tell them to check it out. But check out alexmerced.com and support the show. We could always use more help so that we can do more episodes, better episodes, etc. Just go to donate.alexmerced.com. That's donate.alexmerced.com. I'll see you guys next week.
Thank you for listening to the Alex Merced cast. Learn more at alexmerced.com, libertarian101.com, and libertarianwingmedia.com. Follow Alex Merced on Twitter, Instagram, and Facebook.